All right, welcome back to the Know Your Numbers REI podcast. Your host, Chris McCormack. Grateful and honored that you'd be listening to us today. If you're watching us on YouTube, welcome. We recently fired back up our YouTube efforts, and so if you like to watch video formats, then please go ahead and subscribe. Check us out there. If you're listening on Spotify, we love and appreciate you. Apple Podcast, you as well. And if you have been following along and you like this kind of stuff and you haven't left us a review yet, then I ask you, what are you doing? No, in all seriousness, would really love and appreciate if you guys could give us a 5-star review on any of those platforms. Subscribe and like if that is an option as well. That really helps us get in front of those who are looking for this kind of stuff. The algorithm does some crazy things, and so the more that we have people saying that they like this content, that they think it's valuable, that they've learned something from it, the better. And so we thank you in advance for doing that. Thank you to those who have already done it. And yeah, let's get into it. We're going to continue our conversation on this proposal of the big, beautiful bill that it made its way through the House of Representatives. And as the law works here in the United States, it is now, at the time of this recording, at the feet of the Senate, and they are going to be voting on it. They've told us that by July 4th, they should have it through or make the necessary adjustments. So there's a possibility that it's even been updated, but we're going off of what we found or what we know has made its way through the House. And if there are further updates or this ends up being changed, then you will hear it from us as well. We will obviously, once this law becomes new law, we're going to be talking about it all the more, but we want you to be aware of what's going through and how it can benefit you or hurt you as the American taxpayer. So a little bit of history. 2017 Tax Cuts and Jobs Act was made a law, and that was in President Donald Trump's first term. It was the biggest tax overhaul that we had seen since Ronald Reagan's presidency in the 1980s, and it really stimulated a lot of the economy. It offered decreased tax brackets for all Americans. It offered qualified business income deduction, which we talked about last week. It offered different deductions that are available to certain business owners, think oil and gas. And this one that we're going to be talking about today, or part of what we're going to be talking about today, was also that. And this is real estate specific. So these are for the real estate investors out there. These are the real estate specific changes that we're looking at. Things that were in effect as of 2017 as a part of this Tax Cuts and Jobs Act are bonus depreciation. Bonus depreciation adds a benefit to the use of cost segregation. Well, let's see. 2025, it has decreased. What was 100% has decreased all the way down to 40%. Next year, if current law stays the same, it goes down to 20%, and then the year after that, it's completely phased out. There is no more use of bonus depreciation if we don't pass a new law. And I'll be getting into the specifics about what bonus depreciation is, what that means for you. But just know at the start of this, before it started phasing out, it was 100%. And real estate investors, if you've done things like cost segregation, if you've worked with a proactive tax accountant, even if you're not in the real estate space and you've just invested in assets and you did it 4 years ago as opposed to doing it right now, you have seen a big difference in your tax bill. If you've done it now, you would have seen a bigger difference, a bigger impact, a bigger positive impact on your tax bill through the use of bonus depreciation. The good news is that the current law, what has gone through Congress and will go through the Senate, this big, beautiful bill, which could become current law, brings back some of those increased benefits that we've seen. Other things like opportunity zones, another piece of that Tax Cuts and Jobs Act that has temporary end dates, or it was temporary in nature and therefore it has an end date. Those are going completely out here in the next couple of years. It's in the big, beautiful bill. They are recommending that those stay at least for the time being. And so again, this goes back, and if this is the first episode you're watching or listening to on this, I encourage you to listen to the first two as well. We talked about some of the details there. One of them being that when Donald Trump and his cabinet and Congress passed this first Tax Cuts and Jobs Act, they made a lot of them temporary in nature. And so we're facing this cliff that's like, oh no, if the year ends and there's not a new law, we're going to see increased taxes. And this same thing applies when it comes to bonus depreciation, right? If it was 100% and now we're dealing with 40% and next year we'll deal with 20% and then it's not even an option, you can bet your bottom that there will be an increase in taxes. Good news is, again, there is provisions for this special depreciation allowance. Here's what it says under current law. Taxpayers are generally required to deduct the cost of property used in a trade or business over a period of time. Think depreciation. If you buy a property used in trade or business, then it gets depreciated over a period of time, 5, 15, 27, 39 years. However, in the case of certain qualified property, including most equipment and machinery, a taxpayer is permitted to deduct a percentage of the cost in the first year that the property is placed in service. They have in quotes and parentheses, immediate expensing. For qualified property placed in service in 2025, a taxpayer is generally permitted to immediately expense 40% of the cost. For qualified property placed in service in 2026, a taxpayer is generally permitted to immediately expense 20% of the cost. You see a deduction of 20% from this year to next year. It was a 20% decrease from last year to this year as well. This is not good. This is the cliff that I was just talking about. The provision. So what's in this big, beautiful bill that the Congress has already passed and the Senate is now voting upon? This provision allows taxpayers to immediately expense 100% of the cost of qualified property acquired on or after January 20th, 2025 and before January 1, 2030. If you bought property in those first 3 weeks of 2025, sorry to say, but 40% is what you're stuck with. If you bought property from January 20th up until the end of this year and even going through the end of 2029, then you are in luck, assuming this comes through and passes as a law. 100% compared to 40%, compared to 20%, compared to 0%. That means that if you buy a property, then the qualified property inside of that, assuming you use a cost segregation study and an engineer to go ahead and run diagnostics and get you a breakdown of what all is included in that property and how much it is in value and the basis or the cost associated with that. Let's assume that you do all that. There is going to be a piece of that can be deducted 100% in year one, in the year that you placed it in service. That is a huge benefit. I'm telling you, this could be 25% of the purchase price of any property, even greater than that potentially. So there are massive tax savings to be had. We talk about cost segregation. We talk about bonus depreciation. This is bonus depreciation. And it's not just for real estate investors. We have doctors, we have dentists, we have physical therapists, we have people in the medical practices that invest in equipment and assets and things that they have in their business just because they need them, right? All of that dental equipment that you see when you walk into the dentist, there's a dollar amount tied to that. Typically, it's depreciated over 5 years. This law will allow you to depreciate it, expense it all in year one. Even if you take a loan out, even if you finance it, it's tied to the purchase price. It's just like if you were going to buy a property and it was depreciated over years. Just because you didn't put $500,000 down on a $500,000 property doesn't mean that you don't get the full expense. Same thing applies if you buy equipment or other assets that can be depreciated and qualify for this. Again, it's most equipment and machinery. Guess what? There's tax strategies out there that you can make use of. You can invest in businesses that lease out equipment and allow you to take on the depreciation deductions associated with it. That is a complex tax strategy. If you are a high income earner, that is one thing that you could be looking towards. It requires a meticulous plan and the action associated with the plan. It requires you to invest. There's a return on investment that comes. That if you are above $500,000 in adjusted gross income, you should be talking to us about that strategy. Because most of you might not be in that, then let's not talk about it. But just know, for those that hear this and are, this depreciation deduction allows for that benefit to be all the more of a benefit. You get an ROI and you get tax benefits in the form of depreciation that flows to you on a personal level. So bonus depreciation increasing to 100% results in more money in your account, more money to invest in more properties, invest in more equipment, invest in more of your business development and the growth of your portfolio. This is a good thing. If you can keep 100% of taxes or 40% of taxes, then that's worth it. We want that, right? It's simple math. Like, it's not that complicated. There's some legal jargon here that we want to be aware of, but at the same time, it can lead to us being confused. Just know that bonus depreciation allows you to expense in year one what would traditionally be expensed over the course of 5 years or 15 years or even 27 years. That's a good thing. Under current law, you get a 40% deduction in year one. Under this provision, it's 100% deduction. This can easily multiply your portfolio. Now, the one thing to be aware of is that there is an expiration date on this one, just as there was in the past. So there is a ticking time bomb. Again, this is all under the assumption that this goes forward and becomes a law. When this passes, this 100% bonus depreciation is not permanent. It's not made permanent like QBI deduction, which we discussed. This is a temporary deduction. If you want to hear my thoughts on that, you can go back to the first episode we did on this big, beautiful bill, where I talked about the fact that I don't like that there's a ticking time bomb, that there's this cliff that we're approaching, or it seems like we're always approaching. And then we're going to have this discussion. Oh gosh, there's tax strategies that are expiring. We need to be aware of those. We need to put in a new law. Otherwise the American people are going to pay. Like, that's what we're dealing with right now. And I don't want to do it again, but this is better than the opposite. This is better than the alternative, in the fact that 100% bonus depreciation is better than 0% bonus depreciation. You with me? All right. The next piece is, again, another real estate related strategy that was very relevant in the early stages of 2017 to 2020, call it. It allowed a lot of investors to sell properties completely free of tax and then get that into a new property in a development area of the country, where now they are investing in what might be underinvested areas, right? If you are kind of following along with this terminology, it's what's known as qualified opportunity zones. Qualified opportunity zones allow you to take money that would typically be taxed at capital gains rates. So you would pay capital gains tax. So say you sold a property, and then you can invest that money into what is known as a qualified opportunity zone. And if you meet certain requirements, then you get that first sale completely tax-free. Here's what current tax law says. Under current law, opportunity zones exist as a temporary policy that have been used as an economic development tool to revitalize distressed communities across the country. So this was put in place to offer an incentive for investors, taxpayers, people in the real estate space to reinvest their profits into distressed communities that might not see the investment dollars had there not been this incentive. It led to a lot of investment in these areas, and you've seen over the years. We have partners. We had Barrett Lindbergh on this podcast probably a year ago, and he was talking about this very strategy and how they use it in Texas, and it has blessed the community there. Created in the Tax Cuts and Jobs Act, again, familiar verbiage, opportunity zones are census tracts that meet the definition of low-income community and that were nominated by state governors and certified by the U.S. Department of Treasury as eligible areas for qualified investments to be made in exchange for certain tax benefits. The program was created as a temporary policy existing over a 10-year window as an initial round of opportunity zone development. Low-income community, they have some definitions. Census tract that has a poverty rate of at least 20% or a median income that does not exceed 80% of the area median income. So you can see that they want you to reinvest your dollars that you made from other investments into these areas to incentivize growth in those areas, incentivize investment, incentivize prosperity in those areas. Qualified Opportunity Fund, an investment vehicle with the specific purpose of investing in opportunity zones. All qualifying investments must be made through qualified opportunity funds in order to be eligible for the tax benefits. So that's a big piece of this, right? You have to put your dollars in a qualified opportunity fund who then invests in the properties in the opportunity zone. You can't just say, oh, there's an opportunity zone over here in Tallahassee, Florida. I'm going to take it upon myself to invest in this area. No, you have to put your money in the fund that then has to put the money into that area. Similar to when you do a 1031 exchange, you have to put your money into an intermediary. You have to put your money into another person who then holds on to the money so that you can't just go run wild with it. And then you have to invest it in that qualified property for the 1031 exchange. This is really no different. All right. So this was something that was in place in the 2017 Tax Cuts and Jobs Act. You could hear in that verbiage that it was expiring over the course of 10 years. This was kind of their trial run, if you will. I'll take you through the tax benefits over the 10-year window, and we can then talk about the provision, what they're recommending. So the Opportunity Zone program operates over a 10-year window and provides investors with 3 tax benefits for investing their unrealized capital gains into eligible distressed communities. 1, a temporary deferral on taxes for capital gains rolled over from a non-Opportunity Zone investment into a qualified opportunity fund to be invested into an OZ. The taxes are not realized until 2026 or when the asset is sold/disposed of, whichever comes first. Okay, so if I sold a property in 2018 and then I took the gains, the capital gains, and put them into a qualified opportunity fund, which then would be invested in an opportunity zone. Notice that it doesn't have to be invested in by the time that the end of the tax year comes, right? It's just me putting the money into a qualified opportunity fund. They're going to invest when the time comes. The taxes are not realized until 2026 or when the asset is sold. Okay, so if I sold it in 2018, put it in a fund, I am not paying taxes until 2026. So yes, there is a time period that, okay, those taxes aren't completely gone away with according to that one tax benefit, but it gives you some time to think about it. It gives you some time to possibly, okay, that's 8 years to invest in new properties. And then I can maybe do a cost segregation in 2026 to then make use of tax savings that wouldn't be available to me if I just sold the property and paid the taxes back then. Tax benefit number 2, a step up in basis on the previously earned capital gains that were invested in a qualified opportunity fund. Investments held for 5 years receive a 10% step up in basis, and investments held for 7 years receive an additional 5% step up in basis for a total of 15%. Okay, so there's an added benefit. So if I sold a property for $200,000 or bought a property for $200,000, sold it for $300,000, I have a $100,000 gain. Let's say we were paying taxes at the 15% capital gains rate. That's $15,000. All right. That money was into a qualified opportunity fund. So I'm deferring that $15,000 by putting it into a qualified opportunity fund. I hold that property. I hold the money in the qualified opportunity fund for 5 years. I receive a 10% step up in basis. What was $200,000 now goes to $220,000. 10% of $220,000 plus $220,000. My gain went from $100,000 down to $80,000, right? And depending on how the cards fall, you could potentially eliminate capital gains by just receiving a step up in basis, because your capital gains could be less than the initial capital gains tax bracket, right? There's a 0% tax bracket on capital gains, and you might fall into that. But let's just assume that we're still in the 15% tax bracket. What was $15,000 is now 15% of $80,000, which is $12,000, right? So that's 5 years. 7 years, I hold it. I keep my money in there. The basis has now stepped from $200,000 to $230,000 because it went from a 5% or a 10% step up in basis to a 15% step up in basis. 15% of 200 is 30,000. We now have 230,000. Our gain went from 100,000 to 70,000, eliminating $30,000 worth of that taxable gain, which again, at the 15% tax bracket is $4,500, right? That's a lot of money to hold on to. And this is a smaller transaction. We have clients that are doing big time transactions, and these numbers have another zero on the end of it. Then the last piece of this, remember the taxes were threefold. The tax benefit was threefold. Investments held for at least 10 years, taxpayers receive a permanent exclusion of taxable income on the gains resulting from the original investment. You hear that? A permanent exclusion. So you can see what they're doing here. They're incentivizing, not only are they incentivizing investment, but they want the investment to be held long-term. They expect that as somebody who has these types of gains to mitigate taxes on, you are a quality investor. We want you investing in our community for the long haul. So in order to incentivize that, we're going to let you hold the property for 10 years and exclude the taxable income on the gains from the original investment. So in that case, if you held that $100,000 gain investment for 10 years in this qualified opportunity fund, you don't pay taxes. It's beautiful. It's amazing. Right? But the problem is that this is set to expire after December 31, 2026. Under current tax law, by the end of next year, this is done away with. People won't be reinvesting in these underprivileged communities. People won't be using this as a tax strategy. People will be paying more taxes, and the communities will suffer as well, right? The assumption is that when they're investing dollars, the community is benefiting from those dollars, and thereby by taking away the opportunity for this investment to happen, or the incentive for this investment to happen, it's probably not going to happen, and the community is going to suffer. So then what is provision? The provision creates a second round of opportunity zones, adjustments and improvements to the previous policy. The definition of low-income community is narrowed to census tracts that have a poverty rate of at least 20%, median family income that does not exceed 70% of the area median income. So the 20% stays the same. Poverty rate of at least 20%, or median family income that does not exceed 70% of the area median income. So what was 20 and 80 is now 20 and 70. So we're going to be investing in even lower income communities, right? These are even less privileged communities. And there is a guardrail added to ensure that the term low income community does not include any census tract where the median family income is 125% or greater of the area median family income. So because they have these two parts, right? 20% of a poverty rate of at least 20% or median income that does not exceed 70%, it's possible that you could have a poverty rate of 25%, but the median income could be 150% of the area median family income, right? Okay, think about it from, we're in Minneapolis. If you have, Minneapolis is a big city. if you have a neighborhood in Minneapolis that has a poverty level of at least 20%, say 25%, but there are people in that family, in that area, that are making 150% the average median income of that area, of the city of Minneapolis, they would likely be excluded because there's a big discrepancy. Even though the poverty level is high, there's people that are making a large amount of money in that area that would then disallow that area from being an opportunity zone. It also, I mean, there's some parts in here that are simply just like housekeeping pieces. So 33% of designated opportunity zones must be comprised entirely of a rural area. So rural versus urban. So, I mean, you can think of this like J.D. Vance was from, he was a senator of Ohio, but he lived in Kentucky, I think, at one point, right? There's the book Hillbilly Elegy, which is a great book outlining his story, his life story. And so it seems that they want to, rather than investing so much in the urban areas, at least 30% of the areas that are qualified opportunity zones must be rural, and that they must be like farmlands or more like outside of the city limits, because J.D. Vance has seen the disaster that is these communities and where they are and how they are really the forgotten ones. And so the bill is saying that we want, if there's 100 tracts that are designated as opportunity zones, 33 of those need to be in rural areas away from the city, population levels less than whatever they're going to use to determine rural areas. So you can see that tax policy influences investment decisions, influences business decisions, influences more than just taxes, more than just the money that you're making, right? As business owners, as real estate investors, as people that are going after the American dream and chasing after whatever it is that calls to you, you're not just increasing the wealth that you hold. It's providing a benefit, right? That is the business model. That's the model of business. That's the model of capitalism, is I provide you value. You give me less value than I'm providing you in the form of dollars, right? If I save you $20,000 and you pay us $3,000, it's good for us because we make money, we pay people. It's good for you because you keep $20,000, right? If I'm a real estate investor, I put money into a property, I fix it up. It's a beautiful property. It's working. It's providing housing for people who need housing. That's a good thing. You get a return on that investment. Same thing here. If we're putting funds into these rural areas that might be forgotten about, well, the result of that is that there's going to be a benefit from that. Their lives are going to improve. Their living situations are going to improve. They're going to feel a higher calling because you surround yourself with things that are of quality, and all of a sudden you want to increase your quality, right? So this isn't necessarily taxes right now, but I'm just telling you that they are looking for incentives to the American people to help out the other Americans who might not always be a part of this. As it relates to the taxes, yeah, there's going to be tax savings that come. They still have that 10% step up in basis. You guys, I haven't gone through the full lettering of this. You get my real-time reactions. Provision simplifies the investment incentives and creates rural qualified opportunity funds. So those are probably the 33% of the investment needs to go into those rural qualified opportunity funds. Investments made in a QOF, so regular qualified opportunity fund, receive a single step up in basis of 10% when held for at least 5 years. Rural areas, investments must be made into a RQOF, Rural Qualified Opportunity Fund, and will receive a 30% step up in basis when held for at least 5 years. So what was 10% in just a regular qualified opportunity fund, if you hold it for 5 years in this Rural Qualified Opportunity Fund, you get a 30% step up in basis. So rather than buying a $200,000 property, selling for $300,000 property, rather than seeing that increase from $200,000 to $230,000, right? That's the 15% that we were dealing with. You now have a $200,000 to $260,000. You have a 30% increase in that basis. Now your gain is $40,000 as opposed to $100,000. That's insane. That's amazing. That's a 60% decrease in the gain, right? Because you increase the basis, you decrease the gain. Additionally, taxpayers may choose to invest up to $10,000 of post-tax ordinary income into a QOF or RQOF, and a special rule is created that lowers the substantial improvement threshold of existing structures from 100% to 50% in rural areas. So it seems that the investment that you make, or the opportunity zone, so what it was a typical investment, a typical capital gains deferral strategy, right? If I have capital gains through the use of stocks, bonds, crypto, or real estate, then I could use this to help defer the taxes. That's great. But what this is saying is that now, if I have $10,000 that I want to invest, I can receive a deduction in my income by $10,000 post-tax ordinary income into a QOF that would, by my understanding, decrease your taxable income by $10,000. Now, when this becomes law, we'll need to finalize these details and make sure, so don't take this as Bible and go and take it to the bank, obviously, because qualified opportunity zones under current law are expiring. The last piece of this is that the second round of OZs will begin on January 1, 2027, so it hasn't started yet. 2025, it won't start till the first round ends, and then they will end on December 31, 2033. Who knows what happens after that? Again, a ticking time bomb, but it gives us something to work with over the 6 years that it's around. This is a great opportunity. I think there's great reasons to be excited about this. Now we have to see it go through the Senate and be passed. Again, people are a little hesitant to pass this, conservatives and Democrats alike, because of the national debt. I mean, yes, that's what, qualified conservatives have said that. Senator Ron Johnson from Wisconsin has said that he doesn't want to pass this bill as it currently is because it doesn't do enough to address the massive debt that we have and the deficit spending that we've been just living with over the past 10 years plus. I think Obama was probably one of the first ones to increase or have a deficit in his presidential tenure, and I could be wrong on that. Trump had a deficit in his first term and Biden quite a bit in his term. So we'll see if this becomes a law, but understand that there's great benefits for real estate investors, right? You have bonus depreciation, you have opportunity zones. There's great opportunities for business people, stock investors, crypto investors, right? If you have a capital gain, opportunity zones are fair game. So if crypto goes up or continues to go up, right? It was at one point $20,000 and now it's $100,000. If you held for that long, like, you have massive capital gains that you have to be aware of. What are you going to do to avoid those? You can take the dollars out of crypto if that's what you want to do, and then invest it in opportunity zones. This is a great opportunity, and there's a benefit in the form of social benefit, right? You're providing a social benefit. You're increasing the livelihood of others who are often forgotten by investing in these opportunity zone areas. All right, that was a lot. There's so much here. For you guys that are listening, understand that these benefits under current law are going away. We've used these strategies for some of our clients to help save on taxes. We now have to start thinking about, okay, if this is no longer a strategy for clients who have capital gains, what are we going to do? How are we going to defer or avoid or mitigate those taxes? You have to do that the same way as a business owner. In fact, it's more of your responsibility to find somebody who's going to work with you and proactively plan. If this becomes law, then there's great opportunities. You still have to plan around it. I've seen client, prospect after prospect come through our door. 2 years ago, they sold a property, did nothing to save on tax, and they paid a massive tax bill. They just thought it was the cost of doing business. People, there are ways to increase your wealth, ways to pay very little in tax, ways to reinvest in society, ways to grow your portfolio and not pay taxes on it. It's on you to find the answers. I trust this was valuable. If you're looking for a strategic tax advisor, we are keeping slots open for the 2025 tax year. We don't work with everyone, but those who do work with us do receive a massive benefit, a relationship with myself, communication on a regular basis, and up-to-date insights about what's going on in the tax world. That sounds like you. Feel free to reach out to us, visit us on our website, reach out to me on Facebook, LinkedIn, Instagram, and we'd be happy to get in touch. Until next time, God bless you and keep moving forward.